The broadcast is now starting. All attendees are in listen-only mode.
Thank you very much for joining us today for this webinar on the IC Disc and savings for exporters, the cash benefits of IC Disc and export credit insurance. It's sponsored by the XM Bank and Alliant Group. Very pleased to have you here today. Next slide. This is on the interest charge domestic production. Just to give you a background, I'm your host for today, and I'm Dean Zerby. I'm a National Managing Director for Alliant Group, and was on the Hill when a lot of this legislation was put on place that created this provision. So have kind of that background of the big picture of what the provision's all about. But here's a fellow you really are going to want to listen to is David G. He manages the IC Disc program for Alliant Group, and as you can see, has just done a huge number of these IC Disc studies over the years, and just knows that every way comes Sunday. So he's going to be giving you everything and anything about it, and be answering your questions as well too. Feel free to get to our questions, and if we don't get to a question by the end of the day, don't worry, we're happy to reach out afterwards and answer it for you. So do appreciate the questions. You can see a little bit of background on Alliant Group. We work with businesses and CPAs kind of as a back office, helping them on some of the technical tax issues. IC Disc is a good example, an export incentive, R&D credits another one, energy incentives. That's kind of where we come in and work with your local CPA, helping them and helping you as a business owner to take advantage of those benefits. So that's a little bit of who we are. Next slide. So what we want to do is kind of give you some background in legislative history, but really the key is to make you understand how the IC Disc is structured and how it's taxed, the requirements for it of who can benefit, who's potentially going to benefit, and also understanding how it's going to hit your bottom line. It's basically quite a very good tax savings for folks. You're effectively getting dividend rate taxation for what would otherwise be ordinary income. So it's well worth the hour with us today to find out how it works. It's a big plus up for folks. We've worked with thousands of companies and helped them really get a lot more black ink on their bottom line. So a good day to spend an hour with us, and then we'll go through some case studies. I want to go through, David, I'm going to hand it over to you here too, to first start with just the structure. You've got to kind of have a structure in place to take advantage of this in terms of your overseas earnings. So David, why don't you take it from there?
Perfect. Thanks, Dean. So the IC Disc, these things have been around in some shape or form since the early 70s. So they're not new, and they're actually permanent tax law. And under the right circumstances, they can result in significant tax savings for exporting companies. What it is, it stands for Interest Charge Domestic International Sales Corporation. So it's an acronym for that. And what it is a paper entity that exporting companies can set up. So this paper entity has to be set up domestically. It's a U.S. corporation, and you really want to be careful in choosing a state that recognizes this as being tax exempt. Delaware and Nevada are probably two of the most popular, but there's probably 15 other states that recognize this as being exempt. And when you set it up, it can only have one class of stock with at least $2,500 of par value for the stock. And so you should open up a Disc bank account with the initial capitalization of at least $2,500 in that account. I'd actually recommend you put in at least about $3,000. You never know what types of bank service charges you might have to pay, and you don't want to risk falling below that minimum par value of $2,500. And when you set the Disc up, this corporation up, it has to file a election called a 4876A election that has to be prepared and submitted to the IRS for approval, and that election has to be made within a certain time period of the Disc being formed. So you've got to make sure there's a lot of time-sensitive matters that you have to concern yourself with to make sure that this Disc is being established properly so that it creates those tax benefits. And when you set it up, what it does is it simply acts as a commission agent for your foreign sales. So nothing would change for your operating company. If you're an exporter, you would still make your products, acquire your products, sell those products, invoice your customers, and collect all the revenue. The only difference now with the Disc in place is that you're able to funnel away some of that foreign trade income to the Disc via a commission payment. So there on the right-hand side of your screen, you see a graphic where the exporting company is ABC Inc. They've also got a disc in place. Both those entities are owned by the same shareholder, so it's set up as a brother-sister controlled group here. And the disc is providing services for those export sales, and in return for those services, the operating company would make this commission payment to the disc. And so as you make these commission payments, what happens on the operating company side is, if you're making $100 in commission payments, then the taxable income that you're able to report by the operating company gets reduced by that same commission amount, because these commission payments are ordinary necessary business expenses. And so if you're reporting $100 less in commissions, then you get to save, depending on how it's set up, you get to save $40 in taxes, assuming the max tax rate for flow-throughs. And so that's where the tax savings comes into play. Now the disc, when it picks up that commission income, if it's set up properly in the proper jurisdiction, then it's going to be federally and state tax exempt. So it won't pay any taxes at that entity level. So now the next question becomes, well, how do you get access to that cash? And the way you get access is by having that disc dividend that income out to its owner. And again, you have to structure these where they're owned by the same people that own the operating company. And when those shareholders pick up that dividend income, you're only taxed 20% on dividends, as opposed to the 39.6% you're taxed on ordinary business income. So this disc structure basically allows you to recharacterize a significant portion of your foreign trade income from OBI to dividends, which are taxed at much lower rates. So it creates an arbitrage between those rates, which is really what generates that tax savings. So structuring a disc. For an S-Corp, if your operating company is a flow-through, an S-Corp or a partnership, you can set the disc and the operating company up as either a brother-sister company, where they're owned by the same shareholders and the same percentages, or you can set it up as a parent subsidiary company, where the disc is a wholly owned sub of the operating company. Parent subsidiary relationships are typically much more common for these types of structures, because it makes it much easier to mirror changes in the ownership of the operating company. If you've got an operating company S-Corp where you've taken on a new shareholder, if the disc is a wholly owned sub of the shareholder, there's no corresponding change that needs to be made in the disc. So it just makes things a lot easier administratively going forward. And so for an S-Corp, your tax savings that you're achieving is roughly about 19.6% of whatever commissions you're able to identify and pay over to the IC disc. Now, if your operating company is a C Corp, that's a different story. For a C corporation, the disc and the exporting company have to be established as a brother-sister company in order to realize the savings. And for a C Corp, the tax savings are typically much higher, because not only are you reducing the tax rate for that income, but you're also eliminating that income from being double taxed. So there's a twofold savings. Typically for C Corps, your tax savings is going to be about 28% of the commissions that you're able to identify and pay over to the disc.
David, it's obviously a real good kick in terms of tax savings. I think, for folks listening, it may seem a little bit daunting. I always hate that we start with kind of here's the structure, but you're right, they need to understand it. But I think probably good for them to understand that obviously we have done these all the time, and this is fairly straightforward. In other words, this isn't. I think we find this pretty. Obviously it's work, but it's not. Trying to put the mountain together to get these entities set up. Is that fair to say?
Yeah, you're absolutely correct, Dean. Because the disc is a separate legal entity that you'd have to set up, but because these discs are simply commission discs, where you're not really moving any operations, you're not really moving any employees, and you're not really taking on any contracts in the disc, it's really easy to get into, and it's also really easy to get out of. So very, very common question where, companies might have a big foreign sale coming down the pike here, but maybe it's a one-off sale. It's not something that's going to be consistent or regular over the next few years. Well, it's very easy to set up a disc, get into it now, take advantage of the savings that singular transaction has to offer. But because, again, you're not really moving any activities there, it's simply, you have to almost think of it like being a ghost commission sales agent. You're able to pay commissions, but you're not really doing anything, you're not really moving anything there. So it's really easy to get out of if your foreign sales, cease to exist going forward. But you're absolutely right, it's typically pretty easy to get into and out of.
I want you to get into the key thing for folks listening of, how do I, am I going to be qualifying? And it's pretty straightforward on that. But you raised a point I just wanted to emphasize before I forgot, that unlike a lot of other tax benefits that we work in, like R&D credit, energy, where you can kind of go back years and open years and take advantage of it, the IC disc, folks, is only about going forward. And David kind of alluded to it. He said, hey, if you've got a big sale coming out, and that's what I mean is, we can set these up, and folks can set these up very quickly to take advantage of it, but it is a prospective only tax benefit that you've got out there. And so it is worth kind of putting some giddy up if you're like, hey, we're about to sign this, we're about to put this in place, you'll be thinking, hey, why don't we get this structure set up as well too. But I'm sorry, David, go ahead and walk through the requirements.
Yeah, you're absolutely right. If somebody were to enter into a DISC today, you'd be able to accrue and pay commissions to that DISC on shipments that leave your facility on today going forward. So if you had a big export sale yesterday or last month or last year, those prior sales are essentially water under the bridge. So absolutely, if you're listening and you've got regular and consistent export sales, you definitely want to make sure that you enter into that DISC as soon as possible. Especially before a big export transaction is about to take place, so you can take advantage. Moving on to some general requirements. So there's a couple of general requirements in order for a DISC to be valid. First, you have to have 95% of its gross receipts be from qualified export sales, which includes sale or lease of export property. It also includes related and subsidiary services, things like warranty and repair, installation, maintenance costs, transportation, warehousing, any of those types of services that you might be providing can also count as, and any receipts associated with those services can count as qualified export sales receipts. Engineering and architectural services also count. So this is a real common misconception. People think that the DISC only applies to companies that are manufacturers or people that are selling tangible goods, things that you can feel. But if you're providing architectural or engineering or construction services for a project that's designed to be constructed outside of America, so if you're working on a building right now that's designed to be built in Canada, then those services from that design activity, that design project, can count as an export project, export receipts. So critical thing there. A lot of people aren't aware of that. Software companies also. If you're a software developer, and you've got users that are downloading your video games or your software applications, whatever it might be, at a foreign location and using it there at a foreign location, then those receipts count as export sales as well. And then commissions, any type of commission on any of these types of receipts qualifies as qualified export sales receipts. So here's the first polling question for today. If you could take a few seconds to answer the question, what type of company are you? A service provider, a manufacturer, a wholesaler, distributor, or other? If you could check the circle on whichever type of company you are.
David, as you were going through that, it made me think of one of the big things we see, I know in our work, and I think good for the audience to hear, is so many people, they get it, well, hey, I build bicycles and I sell them overseas. That they understand, but so many of our folks that we help say they're the fellows that put build the engine for the airplane that goes overseas, and that can count as well too. But you probably can elaborate that and say it better than I can.
Yes, a lot of times you have to look at your product and where it exists within the supply chain. So you might be producing something that gets sent to another U.S. manufacturer that then incorporates your product into another bigger solution and then exports it. So depending on the industry in which you operate, and Dean, you mentioned kind of an engine type example that goes into another product. As long as the other product, the airplane or the car, whatever it might be, is exported, you can still take advantage of those indirect exports as being eligible. So not only if you're selling directly to a customer in Canada, but if you're selling indirectly where you're selling to a domestic company, that turns around and uses your product in a foreign location or resells your product for use in a foreign location, then those indirect exports also count.
Yes. Well, good. Well, I saw we had in the audience poll a heavy number of folks for manufacturers. That's great. This is right over the plate for possibilities, but also for wholesale distributors and service providers could also be folks that could qualify as well too. Just quickly on that, Dave, when you think of a wholesaler or distributor, what is it that you think of yes, here's some folks that should be looking harder and sharpening their pencils on the IC disc?
Yeah, there's a lot of companies that are just merchandisers where they might be buying something from a U.S. producer and then turning it around and reselling it. Recyclers are a good example. There's a lot of recyclers that are buying scrap metal, whether it's ferrous or non-ferrous, and then exporting that scrap to be used in Asia, for example, or agriculture. There's a lot of co-ops and things like that, or organizations that buy different types of agriculture products and then export those products for consumption in Asia. And so those types of distributors are great examples of companies that can take advantage of a disc. And we've actually got some case studies on those types of companies later on in the slide deck as well. But absolutely, it's not just limited to producers or manufacturers. Distributors can also qualify. Although there are some other caveats to distributors, the more indirect you get from the production, the more difficult it might be to kind of have the supporting documentation, but we'll talk through some of those facts. The other general requirement is that you have to have at least 95% of your assets be qualified export assets. And for commission discs, your only asset is your cash and your commission receivable. Basically, the idea here is you shouldn't put any non-export assets into the disc, but most discs are commission discs and you have little to no other business assets because you're not really doing anything in that entity other than receiving commissions and dividending those commissions out. So it's typically a non-issue. Where it can become an issue, though, is if you use the disc, the commission income in the disc to enter into investments or buy property in the disc, things like that. I would never recommend doing something like that because you run the risk of invalidating that preferential tax treatment if you run afoul of that 95% test. So just be really careful with that. Qualification of export property. So once you've got a disc in place, the sale, the product that you're selling, that you're exporting, has to meet 3 basic tests. First, it's got to be property that's manufactured, produced, grown, or extracted here in the U.S. It also has to be exported. And third, but not least, it has to have at least 50% American content. And you've got to be able to meet all 3 of these tests in order to qualify. If you fail on one of these 3, then that underlying transaction is ineligible for commissions. So be very careful here. We'll talk through each of these in a little bit more detail. So the manufacturing test, it has to deal with property that is MPGE, manufactured, produced, grown, or extracted here in the U.S. And manufacturing includes substantial transformation, examples like making paper from wood pulp. It also includes other operations that are significant in nature and generally considered to be manufacturing within your industry. And then there's also a safe harbor where if you can show that your conversion costs, so your direct labor and factory burden, account for at least 20% or more of the cost of goods sold, then you meet that safe harbor and you're automatically considered to be a manufacturer. The most objective way to qualify is through that safe harbor method. That's going to make things a lot easier for you in the event that you have some sort of a review. So that's typically the way we like to go as far as making sure that companies are eligible as being manufacturers. So here's just a quick graphic. Here you've got USA company that sets up a disc. It's owned by a U.S. shareholder. And let's say they're in the business of making speakers. And the company imports, that buys a lot of components, $50 worth of components, and then they spend $20 on assembly and packaging operations. And then they ultimately sell those finished speakers for $100. Well, in that case, the conversion cost, the $20 of assembly and packaging, would be greater than 20% of the cost of goods sold. So 20 out of 70 is 28%, which is greater than 20%, so it would qualify as a manufacturer in that example. The second test is the export test. You have to be exporting these products. Again, it can be either a direct export or an indirect export. Indirect being where you're selling to a U.S. company that turns around and resells it or uses your product outside. Both of those situations can count. But what issues do you think can arise here? Well, if you're an indirect exporter, then you might not have all the bills of lading that show definitively where those products end up. You might have to go to your domestic customer to get from them representations of how much of their product they buy from you ends up being sold or used outside of America. So these indirect sales do count, but it can create some additional hurdles as far as having to collect and gather the documents that you need in order to validate those export sales. So here's another graphic where here you've got the USA company that's now selling to a US distributor, which then turns around and resells those products for use outside of America, and those indirect exports also count for commissions, for discommission treatment. And then lastly, you've got the U.S. content requirement, which says that no more than 50% of the fair market value of the export property can be attributable to imported articles. And you have to look at the value through looking at the dutiable value. And the intent here, right, is they want to reward companies that are selling U.S.-made products with a lot of U.S. content in it. If you're selling products made here in America, assembled in America, but it's all, it's from mostly foreign materials, and that doesn't really sustain economic growth here. That's the key. That's the idea. But the way that they've implemented it does create some opportunity, because now the U.S. conversion, the U.S. labor, and the markup on those products counts as domestic content. So going back to that example, if you had, again, the speaker company in the U.S. that was exporting finished speakers for $100 each, and the components that they were buying only equaled $50 worth of components for each speaker. And even if, in this case, even if 100% of the components that they're buying, that they're putting into the speaker, were all from foreign sources, then this sale of the speaker would still qualify, because that $50 is less than or equal to 50% of the sales price of the $100. So as long as you don't, your foreign content isn't above 50%, then you're good. And in that case, even this extreme example, you'd still be good. So here's a simplified disc example. Let's say you've got a company and you've got $5 million of export sales. Your COGS is $3 million. Your gross margin is 2. SG&A is 1.5. That leaves you foreign trade income of $500,000. Foreign trade income of basically 10% of your sales, 10% dropping down to the bottom line. It's pretty typical. Your disc commission can be computed in one of two different ways. One, it can be half of your foreign trade income, which would be $250, or 4% of your foreign trading gross receipts, or your qualified export receipts, which would be $200,000. You figure out which one is bigger. In this case, obviously, the $250 would be bigger, and that would generate a tax savings of $99,000. And that was computed by just taking the $250 times 39.6%, which is the max tax rate for individuals. And by funneling this money through a disc, the disc dividend would only be taxed at 20%. So instead of paying $99,000 in taxes, what this company would be doing without a disc, now they're only paying $50,000 in taxes on that export income. And so their permanent tax benefit is $49K, which comes out to about 9.8%, about 10% of their foreign trade income. So by setting up a disc here, this company would be able to save every year. They'd be able to save 10% of their foreign trade income in tax benefits. That's a pretty big benefit, and that can add up a lot, especially over time, over years.
Right, it's been a huge benefit for the companies we work with. David, you kind of, because you know this so well, kind of just passed over a key point, I think, for folks listening, and even maybe folks who haven't, that have had an IC disc or what have you, is that, one of the things we obviously work with folks is, let's get your paperwork looking just right in case anyone's got questions, but really to, quite frankly, maximize the benefit as well too in the law. But you made this point about, well, there's kind of two paths you can take on the IC disc, and that's a key thing too, is we often find even folks who are doing an IC disc that they're not maximizing the benefit because they've kind of taken the wrong path in terms of maximizing that benefit. Is that fair to say?
Yeah, that's absolutely fair to say. There's one of the big areas for value add with DISC is in the way those commissions are calculated. In that simplified example, it was just a kind of, I threw everything together in aggregate, but the way in practice you would actually put together a DISC calculation is by doing it on a transaction by transaction basis. So individual transactions by individual transactions. And by doing so, you can actually pick and choose which commission method you want to use for which transaction, or which groups of transactions, or which product line, or which SKU, depending on what your margins are for each of those individual sales. And what that allows you to do is basically customize the approach and be able to pay as much, basically generate as much foreign trade income as you can on a T-by-T basis, and therefore generate as much commissions as you can. That can be pretty. I think we've had several examples where, a company was taking very conservative DISC commissions in the past, but we've been able to increase their benefits by 4 to 5 times, just by looking at that T-by-T or transaction by transaction approach.
Yeah.
So run through a couple of case studies here. This is an agriculture client, kind of Dean, what you were alluding to towards the beginning. This company is a exporter of pistachios and almonds. They're all grown here in the U.S. Small company, $4.5 million in sales, of which just under 50% was export sales. But they're able to generate an annual benefit of just under $85,000. That's a big tax savings for a small company like this company. And so agriculture, you'd be surprised how many agriculture products end up being consumed overseas. If you're listening and you're in that business, or you know people in that business, definitely want to look into the DISC as being a potential. The second case,
I think that's the key thing, I think, is to look at, if you've got things going overseas, either it's going overseas or it's being sold overseas or it's in a part, you really need to pause and not self-censor and think, well, I don't know if this is for me. I think of one, David, I think this fellow sent all of his kids through college thanks to you. He was doing animal skins, is my recollection, and was selling them by the millions overseas. And we came in and made it, went through it, and yes, he could qualify for the DISC. And folks wouldn't think about animal skins, but that was, there's a lot of work in that, and he got a huge benefit, is my recollection.
Yeah, absolutely. And a big area that's not asked and that's missed is this indirect exports. I mean, a lot of, we tend to work mostly with CPAs, and CPAs are very familiar with what their clients do, but they fail to ask that question about, how much of your product ends up being used overseas. That's the critical way to phrase it, because they might not have these direct exports. It might all go indirect through other companies, but definitely something to keep an eye on.
I think that's a good point. I didn't, but yeah, military. But that's we love the CPAs and we work with them closely. But no one like the owner knows best where that product is going at the end of the day. And I think we've got a lot of owners on the phone or people from the best. So if you're thinking, well, why is my CPA never brought this up? It could very well be he just doesn't, or she doesn't understand. Well, here's the end user. This is where this is ultimately going.
Right. This next case study is a military sales company, do a lot of work for the defense, the Department of Defense. Again, a small business, about 12 million a year in sales. But as you know, your sales to the military, they get used in different campaigns, all over the world. And so of their roughly 12 million in sales, almost 9 million of it every year ended up being used in various locations all over the world. And they never thought about it before because they always thought, well, they're selling to the U.S. military. That's not an export, but it is because it's used. It's about where it's used, not the customer to which you sell that product to. And so this company was able to achieve $263,000 in tax benefits on those export sales. And the last case study is an architecture and engineering company. This one's a bit larger, about 120 million in revenue. about 15 million a year in exports, and these exports are, the different types of these services, right? They're not tangible products. They never knew before this that a disc would apply to a company that's providing services. But for architects and engineers, it does qualify, and they're able to achieve just shy of $400,000 a year in annual tax savings.
We've got another polling question here. It's a question of, are your products U.S. made, non-U.S. made, or both? And David, we've gotten some few questions on disc. I don't know if we're waiting until the end of the webinar, if you want to look at those now, but I did want to encourage folks again to put in questions. We'll certainly get to them. Even if we don't get into them today, we'll come back to you. So please do that. We're happy to answer everything, and so pleased to be with XM Bank working on this. This is a wonderful incentive that we have from Congress to encourage export sales, encourage export manufacturing. One thing too, I got a lot of U.S. made and both terrific. Well, this is it. This is right over the sweet spot. One thing I'm going to put you to work, David. You're going to be pleased by this. But for folks listening, you should feel free to just contact us too. In other words, there's no meter running. Just by giving us a call and saying, hey, I'd like to run this scenario by you, or I'd like to see if this makes sense to you. David is happy to take those calls, and because he's just done so much of this work, he and his team, they can very quickly, say, well, yes, I think that makes sense for you, or well, maybe that isn't the best, or let's understand it more. So I apologize, Dave, for filling up your evenings, but I think we're so very pleased to help folks get their tax savings. But I don't want you to self-censor or not, be willing to ask the questions, because we're happy to work with you and see if it makes sense. Fair enough, Dave?
Yeah, absolutely. If there's any questions that you have about the disc that we haven't addressed today, or if you have a specific fact pattern about your own company that you'd like to discuss, please let us know. We're happy to discuss that with you guys. And we've definitely reserved some time at the end of the webinar here to have a Q&A for both topics, the IC disc and the export credit insurance that we're so fortunate to have XM presenting on now. We'll pass that off now to Mark.
Fantastic. Thanks, guys. We can go to the next slide. So that's me. I apologize for the picture, but it is what it is. I'm not going to run through this, so we can go to the next slide. Just leave it to the fact that I've been involved in the international banking world for close to 20 years, and I've been with XM Bank about 7 years. So been doing this enough and long enough to know a couple things. The first thing I know is that most of the folks on the line have probably no idea who XM Bank is, or the Export-Import Bank of the U.S. in our long-winded name. So I'm going to cover a little bit as far as who we are as a government agency and this world of ECA financing that we live in. The second thing is I have 10 minutes. I am not going to make anybody an expert on XM Bank and our products and services in 10 minutes. So definitely I'm going to leave plenty of time for questions and answers. We can kind of drill down a little bit. Think of this as the 10,000-foot version, things that make you go, seminar on XM Bank. I'm going to leave this slide up for a couple seconds, just if for nothing else. I want you to really pay close attention to it. If it scares you, it should. That's what it's supposed to do. But a little bit as far as XM Bank goes, we are the official export credit agency of the United States. There is 85 export credit agencies around the world. I think most of your developed countries have a version of XM Bank. Most of your developing countries are growing XM Banks. The role of an XM Bank or the role of ECAs is all about access to capital. And more importantly, access to capital that is not readily available in the private sector. I don't compete with the private sector. I complement the private sector. I make sure that foreign buyers have access to capital that's not readily available in the private sector to buy U.S. stuff, U.S. services. That's what that's what my partners in Canada are doing, Germany, Italy, UK. I'm trying to promote U.S. stuff, U.S. services. My counterparts in Canada, they're trying to promote Canadian-made stuff and services. So Enough about the ECAs and our role there. Let's look at this slide. The first thing that is supposed to scare you is that only 1% of U.S. companies export. That's a low number. The second thing that is supposed to scare you is the fact that we're ranked 144th in the world as a percent of GDP on exports, right there with Rwanda and Haiti. It's not many times that the United States is mentioned in the same sentence as those two countries. As far as gross number on GDP, or on gross number of exports, we're third. China's number one as far as gross dollars. Germany's number two. Sometimes we're ranked number two. We're kind of back and forth with Germany, but China's one, Germany two. We're three in gross dollars, but 144th in the world as a percent of GDP, less than 14%. If anybody's curious as to who's winning this race, it's Germany. They're at 50%. Basically, half of the stuff and services that originate in Germany, half of those are exported. So there's my scary slide for the day. We can go to the next one. So what I want to talk about now is our three core products. Export credit insurance is our bread and butter. That's the lead product that we talked about at the title of this seminar. The idea of export credit insurance is that most transactions, as far as exports go, cash up front or letter of credit based. As a matter of fact, 98% of most transactions involving exports are done in one of those ways. Cash up front, progress payments, bank letters of credit, all perfectly fine. Export credit insurance provides you a competitive alternative. It's basically the ability for you to treat your foreign buyers like you would a domestic customer and offer terms. 30, 45, 60, 90-day terms from date of export. You're in essence selling on open account basis. I know that is not a popular topic with most small business exporters, the idea that you're going to put your product, you're going to perform your service, and wait 60 to 90 days to get paid. My role with export credit insurance is I'm trying to take the fear out of the transaction. I'm going to insure your foreign buyer. I'm going to make sure they're creditworthy, depending upon the type of policy, between 90 to 95% coverage to where you're transferring all but 5% or 10% of your risk over to the federal government. Let me worry about the foreign buyer. You worry about doing what you do. You make product, you develop services. So it's an idea that's going to protect you so that you're going to sleep at night. It's a competitive term. How nice is it when you're dealing with a foreign customer, instead of asking for cash up front, not real friendly, letters of credit, they work, but they can be cumbersome, they can be expensive, and frankly, it's getting more and more difficult for buyers outside of the U.S. to go get those. There is a liquidity issue with a lot of the banks outside of the U.S., so maybe letters of credit aren't going to work. This allows you to be competitive and be friendly and say, I get it. Cash up front's not good. Letters of credit, we're not going to go there. How about if I ship this product to you, you pay me in 60 days? They're going to like that, trust me. The third benefit is you can assign my insured foreign accounts receivable. You can assign my policy over to your commercial bank. There's nothing that will put a bigger smile on your banker's face than knowing that, number one, you've insured your foreign accounts receivable through Exim Bank, and number two, they now know that they can include those foreign accounts receivable in your borrowing base. Your foreign AR is no longer a dead asset. You can actually borrow against it the same as you would your domestic accounts receivable. So it's all about growing your credit availability. Last comment on export credit insurance. After I've just explained the three key benefits, the question I get posed a lot is, wow, I guess this is really expensive. It's not. I want you to think, if you're offering 60-day terms on an export, think about 0.6%, 0.65%. So a $100,000 invoice, you're going to offer 60-day terms to your buyer. It costs $600, $650 on a $100,000 insurance or a $100,000 invoice. Not expensive. Most of the companies I work with, they pass that cost on to their buyer and round up. So the best way to describe that is $100,000 invoice. You explain it to your buyer. You can pay me $100,000 up front the way you always have, or because I like you and, put on your salesman hat, you're willing to give them 60 days to pay. I do have to charge you a finance charge for that. So I'm going to charge you 1% for that 60-day credit. On an annualized basis, that works out to be 6%. 60 times 6%. That's cheaper than the money that they can obtain in country. So you're providing them a cheaper cost of funds than what they can get from their banks, and you're also covering my costs. So you're paying me, if it's a 0.6% premium, I get 0.6, and I always jokingly say that other 0.4% on that invoice, that can go into the company's Friday pizza fund or Friday donut fund. But the thing is that it's cheap. You're covering your costs, and you're making your buyers very happy. Next slide. So I'd be, export credit insurance, it is our bread and butter. It was the lead product on this, but I'd be amiss if I didn't at least talk about our other two core products that benefit business. Foreign buyer financing. The best way to describe this is if you are a manufacturer of capital equipment, there are many times when your buyer is going to look to you to arrange financing. Why are they doing that? Well, if you're selling into Latin America, it's because the interest rates are in the 20s and the 30s, and the banks don't really have a good solution for short-term, lending of any kind. So, they would be looking at, if you're a manufacturer of a crane, and it's $1 million piece of equipment, and your buyer's in Brazil. If they have to finance that in country, 25% in the longest term they're going to get is probably 18 months. I can arrange financing instead of mid-20s on interest rate, let's say less than 8% interest rate, so about a third of what they can get in country. And instead of an 18-month term, I can do it on 5 years. So it's all about making that product affordable to where they can take possession of it, put it in production, and that semi-annual payment at a lower interest rate over 5 years is a whole lot better than a high interest rate on a short term. It is restricted to capital equipment, so it's basically, I always say, it's the stuff that it makes sense for there to be a 5-year loan on it. It doesn't really fit with services. It doesn't really fit with consumables. It's your larger capital equipment items that it makes sense for there to be a 5-year loan on the books. So that's a little bit about foreign buyer financing. Next slide. Last slide is this is our working capital guarantee. It is our, it's a bank product. It's basically if your bank that you have a relationship with, if they need a little bit of help to get you the working capital you need to grow your exports, I can step in with a credit enhancement. It's a 90% principal and interest guarantee to your bank, hopefully to get them comfortable enough with your export business to where they will provide that export working capital to you, and my 90% principal and interest credit enhancement. Just the idea to where it's supposed to, it makes your bank a little bit happier, and everybody loves a happy banker. Next slide. These are my last two slides. These are also just kind of going back to the state of the world we're in. This is total exports. This is Japan, Germany, U.S., and China. China is the dark blue. They're winning the battle as far as gross exports go. Remember, as of 1980, they were a closed market. They weren't exporting anything. So you can see that they have really taken off. Yes, they had a hiccup during the Depression like the rest of us, but they've been a lot faster coming out of that Depression, 2008, 2009, the rest of it. So they're leading the world in gross exports. Next slide. This is the one that should really, this is the one that affects me. This is one that should really scare you to death. This is export finance. So this is what I do. This is, I'm trying to, help U.S. companies export stuff, export services. So you can see I'm the light blue at the bottom. You have Germany and Japan. Export finance, you see that China is just skyrocketing. I will tell you this chart is not to scale. China would be off the screen right now. Just to give you an idea, in the past 2 years, they have done more in the world of official export credit in the past 2 years than what Ex-Im Bank US has done in the 83 years that we've been in existence. So they are really, they're buying a lot of business for their exporting companies with finance. So that's it as far as my presentation goes. We've got 15 minutes for Q&A. I'm not going anywhere, so if we have to go a little longer in the Q&A, that's fine. There's my contact info. Feel free to call me, and I will turn it back over to David, and we'll kind of do some Q&A.
Perfect. So there's both our contact info. If you guys have any specific questions that you'd like to either email or call each of us on, we're happy to speak with you further about how we can help you, expand your business, expand to other markets, because we feel, both of us, we feel very strongly and very passionate about helping exporters, because we know that's what's going to sustain economic growth here. We look forward to speaking with all of you. And again, if you have any questions, please submit them in the chat box. We'll address them either today or in subsequent private conversations. I guess, Mark, maybe we can start with some questions for you.
Sure.
Question that came in: how does Ex-Im increase their line of credit?
Yeah, so what we do is first thing when someone calls me and they're asking a question about export working capital, I always ask, who's your home bank? Who do you currently bank with? That's where it's all going to start, because your bank that currently has a relationship with you, the U.S. banks are not real comfortable with exports. And this is coming from a recovering banker. I can tell you that U.S. banks are not comfortable with exports. So when you need to increase your working capital to grow your exports, that may not be something that your bank is really excited about doing. So that's where I say that the way that I help you get that working capital is that 90% principal and interest guaranteed to your bank. They're, in essence, they're going to be the lender of record. They're going to make this loan to you. It's going to be separate from your domestic line of credit. It's going to be your export-only line of credit. I'm just going to guarantee it 90% principal and interest. That makes your banker very happy when they know that they have spun off all but 10% of the risk on that loan to the federal government. So there again, it goes back to what I said, access to capital. We're not competing with your bank. We're just providing a credit enhancement to your bank so that they're a little more liquid, and they'll make that working capital available.
Perfect. Next question is, Mark, how long does it take to receive a quote on an Ex-Im policy?
Well, the first thing we're going to do is we work with trade credit insurance brokers that are out there in the market. Their role, I pay for them, they don't cost you anything. Their role is they help you navigate the process. Submit an application, get the quote, get your buyers approved, help you manage the policy online. So they do a lot of the heavy lifting for us. I typically say that, give me 7 to 10 days from the date of application. It can be quicker if all the information on your company is provided right at the very beginning. If all the information on your foreign buyers that we're looking to insure, if that's easily to obtain, whether it's bureau trade references, financials, it's a higher credit limit. If that information is readily available, it may be quicker than 7 to 10 days. If I have to go out and really search and find the credit information and the information on your buyers, it may take a little bit longer. But I usually use the time frame 7 to 10 days from date of application. It's typically when we can turn around a quote.
Perfect. Next question would be, this is a multi-part question. What is the application process like? And then secondly, how easy is the application process, and how long would it take to receive a quote? Again, very similar to, I guess, the last question you answered.
Yeah, well, the application, we try to make it as simple as possible, because that's where the brokers come into play. I'm not going to kid anybody. It is a government process. That's why the brokers are there. They help you navigate my online system. They help you navigate the nuances of a government insurance program. So I like to say that the brokers that we work with, I'm also involved with it as well, we try to make it as simple as possible. It's not going to be anything to where it should be difficult. It shouldn't be tedious. So yeah, and there again, it's not, some of our applications for some of our policies, it's a real quick 2-page application, real simple. On some of our other products, it's a little bit longer, but there again, the brokers are there. I'm there to kind of hold your hand along the way.
Okay, next question would be, how can I check my foreign buyer's existing line of credit, and what is role of broker-dealer relationship?
Well, we kind of covered the broker. They're going to help you manage the process. There's a number of ways to check your foreign buyer's credit. What we look at is a combination of, we like trade references. How are they paying other U.S. companies that are giving them open account terms? That's a great way to start. How are they paying people that are in your exact same boat? Credit bureaus. We look at credit bureaus. These are very in-depth products. Many times there's trade references, there's financials built into those. You can order those on your own. The broker that you're working with, they can order those on your behalf. There's products through the U.S. Commercial Service. It's another government agency. We can talk about that offline. They have programs to where they can help you get information on your foreign buyer. So there's a number of sources to where you can, determine, and we can determine the creditworthiness of your foreign buyers.
Perfect. And then maybe we can now transition, and there's several, thanks for submitting your questions. If we weren't able to get to them today, we'll definitely get to them individually, or again, you can feel free to email or call Mark directly, and he'll be happy to address those. There's a few DISC questions here as well that I'd like to address. There's a question posed about states and state treatment of DISCs, specifically for California. California is interesting. They don't recognize this as being tax exempt. However, they do allow companies with DIS in California to reallocate its non-arm's length items back to the parent company. So essentially what happens is all of the DISC revenues and expenses would end up being reported on the parent company, and therefore for state purposes you end up having a net wash. So although the state doesn't recognize this as being exempt, they tax this as C corps, but they also have this mechanism allowing you to reallocate all those items back to the parent company, and so you don't have this tax detriment in California. And if you look at all the various states, they all have their own state-specific rules, and there's probably half the states that are great jurisdictions for DISCs and half the states that are not so great. So planning as far as how you want to structure and how you want to organize your DISC is going to be critical, because the last thing you want to do is get a real big benefit from the feds, but then have to give half of it back to the state. And I've seen too many horror situations of that happening, especially when they're having their DISC administered by somebody who is a great attorney, who knows a lot about just legal entity formation, but they don't know diddly about tax consequences. So if you're talking to somebody regarding the DISC, you have to make sure that they're knowledgeable about not just legal things, but also knowledgeable about tax items, especially when it comes to a DISC. I had a situation just the other day actually where the company had set up a DISC in Connecticut, and for years they'd been having this DISC and taking advantage of it, and for years they've also haven't been paying their Connecticut state taxes, and so now they're having us come in and help them clean up this mess, and it's becoming a really big mess, and it's all because one attorney 3 years ago didn't really know what they were doing, and it's caused a real big issue here. So just be very wary, be very careful about state tax treatment. You definitely want to ask that of anyone you're speaking with. There's a question about sales to foreign subsidiaries. If you're selling to a foreign subsidiary of yourself, does that count? The short answer to that is yes. if you're selling to a foreign sub that then is exporting or selling it to the end user, those transactions do count as export sales, and you can pay commissions on those transactions. There's another question about LLCs. Can LLCs set up disks? LLCs are legal. A limited liability company, that's a legal designation. That's not a tax designation. So an LLC would have to be taxed as a partnership or an S corp or a C corp. And regardless of what type of tax entity it is, you can set up a disk for that entity. There's another question about foreign ownership. What if the operating company is owned by either foreign owners, individuals, or foreign companies? And in many cases, foreign ownership is by no means a fatal flaw for disks. You have to look at the tax treaty between the U.S. and those countries, and many countries are good, and some countries are not so good. And so you've got to take a look at those tax treaties to figure out if a disk does create an arbitrage benefit or not. Okay, and I apologize if I didn't get to the other questions that were submitted. We're happy to address those individually. But again, there's our contact information if you'd like to reach out. And one final polling question here. Would you like to be contacted? If you'd like to be contacted by XM, by Alliant Group, by both of us, or by neither of us, if you could please make your selection there.
Great. Well, thanks so much for all this, David and Mark, for having this webinar today. I think it was most useful. Obviously, I hope it was useful for the folks listening today. And again, obviously, we're happy to work with you in any way we can. And again, our great thanks from Alliant Group for XM putting this all together. And just think it was terrific to do this and make certain that folks are informed about the great possibilities and benefits out there for them in exporting. So thank you all very much, and thank you for all of our audience. Gentlemen, I'll let you have the last words if you've got any last comments.
Yeah, I'd just like to add to that, Dean. We're very excited to bring this information to you guys in collaboration with the Export-Import Bank. And again, my thanks to Mark from XM for joining us here today. It was a pleasure presenting with you, and hopefully we can do a lot more of this in the future.
Have a good afternoon, all.